Hello everybody, it's Yashar here, back again with another video, and in this video I'm going to quickly talk about the massive Facebook stock drop after their earnings report. And then I perform a rapid stock analysis using my personal discounted future earnings model. I bought the Facebook dip this morning, and now Meta is the second largest position in my portfolio. And they have one of the best balance sheets in the whole tech sector in the market. I know a lot of you don't like Mark Zuckerberg or the company policies or Facebook app, which is fine. I personally don't like Facebook app either and don't use it much, but I use their other products and services every single day. I use WhatsApp as my main messaging app and Instagram to connect to my friends and family. I also really like Oculus Quest VR headset, and I use it 2-3 times a week for fun. I'm not going to discuss the details of their balance sheet and their business, but just look at these numbers. You may not like Zuckerberg, but you cannot argue with these numbers here. The company virtually has no debt comparing to their cash position and assets. They grew their revenue by earnings per share by almost 28% year over year in the last 4 years. And they have a massive operating cash flow and free cash flow, which is growing at a crazy rate. However, they did a risky investment and they started to invest their cash position into Metaverse project. And because of that, you will see massive capital expenditures in the next few quarters on their earnings report and balance sheet, which can lead to lower earnings per shares. Company predicts that Metaverse is going to be huge, but it takes time for this sector of the company to show massive profits and return on the investments. I'm not sure if Metaverse is ever going to be huge like Zuckerberg says or not, but I cannot really wrap my head around 25% drop in Facebook share price after earnings. They actually beat the revenue expectations and missed on earnings per shares, which is due to their capital expenditures on Metaverse project. They also reported not so great numbers in this quarter and anticipated slowing down in users and earnings in the next quarter as well. However, Facebook is huge and they have almost 2 billion active users around the world, with a strong moat in social media apps like Instagram and WhatsApp, and they are in forefront of Metaverse and virtual reality headsets. Just look at these numbers and see how they actually lead the VR headset sales in the market by almost 75% of the market share. This sell-off, in my opinion, is an overreaction, and I think the investors that think long-term would not look at one quarter results and sell a company at these low valuations. Here I want to show you my stock analysis based on the financial data from Facebook income statement. I use a discounted future earnings model, which basically estimates values of a stock based on projections for their future earnings. So I make some assumptions about the growth of the company in the next 10 years and then discount the future earnings into the present value of the stock based on my expected rate of return. So I start with the past 4-quarter diluted earnings per shares of the company, and based on 3 different scenarios, I predict the future earnings of the company in the next 10 years. In the bear case, or the most negative case for the stock, the company can grow 15% in the short term, and then the growth will drop to 8% in the long term. This is an absolutely worst case scenario for Facebook when everything about Metaverse fails and they start to see significant slowdown in their ad revenue and users. I consider terminal multiple of price to earnings of 14 for this case, which is consistent with historical bear periods for tech stocks. For normal case, I considered a little bit better growth and a terminal multiple of 18. For the bull case, or the best possible outcome, I consider the business can continue to grow by 30% in the short term, and then it drops to 22% in the long term, and I consider the terminal multiple of 22, which is almost close to their current basically before this correction, their previous price to earnings ratio. So these are really conservative assumptions, and even my bull case is not really unrealistic at all. I assign a 50% chance to the normal case, a 25% chance to the bear case, and 25% chance to the bull case. For growth stocks, I usually expect 15% return, and for dividend stable stocks, I expect 10% return. If I expect a 15% return from Facebook, the fair value of the company is $357, which means compared to current share price of almost $246, the shares are traded at a 45% discount. And it is definitely a buy according to the model. If I change my expected rate of return to 19%, you can see that the stock is still traded at 3% discount. It means if you expect 19% return on your money year over year, this stock is probably going to deliver that 19% and much more in the next 10 years. Based on this analysis, I bought more Facebook shares this morning and will continue to do so if stocks falls even further. I think all of us heard about this Warren Buffett quote that be fearful when others are greedy and be greedy when others are fearful. But at the times like this, we as investors usually don't follow this advice and let our emotions to take control. I think this was an amazing buying opportunity and I personally took advantage of that. I will provide updates on Facebook stock in the next quarter after earnings report again. I hope you enjoyed this video, and if you enjoyed the video, please leave a comment and let me know what do you think about Facebook stock price action after earnings. And please consider subscribing to the channel to see similar videos. Thank you for watching, and I see you in the next video. Farewell.